valuable and effective tool you'll ever have in your trading career. Like when you use a trading plan religiously and accurately, it can all but ensure progressive levels of success in your trading. Because if you don't employ it as part of your daily methodology, your trading methodology, it will most definitely lead to trading on emotion, frequent mistakes, revenge trading, over trading, under trading, premature exiting of positions based on fear. A good analogy would be like with a football player, a quarterback. Quarterback knows all the plays, can make all the throws, has great players, and game day comes up and out he trots onto the field. There's no playbook, there's no game plan because he's a professional. He's got professionals around him. Knows how to throw it, knows how to hand it off, and knows how to call signals and get the snap of the ball. And so he starts chucking the ball around, throwing the ball deep, and then the defense is defending it. So he goes, well, the passes aren't working. Let's try a few run plays. So the defense kind of figures it out, and they move up and start defending the run. Well, that's not moving. Let's try a trick play. Let's try this. Let's try that. Then maybe a couple of passes work out really well later on in the game. So he figures, well, passing's working. Let's just keep throwing. Then you end up with interceptions. You end up losing the game. Most teams, not only do they have a game plan, not only do they have a playbook and a game plan, but they don't make any adjustments usually until halftime, until they get a feel for what's going on, until they've run about 20 to 25 plays, see what the defense is giving them, see the performance, of their players. How are they doing today? And then they make an adjustment. So a trading plan is the same thing. Yes, you're a professional. You want to trade professionally. But you have to have a game plan. You have to have a playbook. And when you don't, you're just chucking the ball around. You're passing a few times here, handing off a few times there with mixed results. You're changing your game plan constantly instead of waiting until you've run 20 to 25 trades or 20 to 25 or 30 plays. You can't make that adjustment beforehand. So what happens is, you put on a trade and it's a losing trade. The next trade you put on, another loser. The third trade you put on, you're like, well, I'm already down 600 bucks. So maybe I won't trade as much. And when you place that trade, you have this fear of losing because you just lost 2 trades. So now you trade a little more carefully. Maybe when the trade starts to go not in your direction, all of a sudden it's down $60. You figure out, you know what? Let me get out of this thing before I lose 200. So you get out prematurely. Or let's say it really starts to move against you and you're not that confident in the setup, so you get out when you're 50, 60%, in a loss. Instead of holding on, having faith in your trade, having faith in the setup. This is the setup that you're going with. This is what you're trusting in the setup. And when it pulls back and you're down about 50, 60%, add to the trade. Add more positions to the trade because it is a natural pullback. But if that's not part of your trading plan, then you get in and you get out, and it's all based on emotion. When you have a trading plan, it takes the emotion out. And that's when you're going to move to the next level of trading. Whether you're a beginner now and you want to move into the next level, whether you're an intermediate trader, you have $3,000, $4,000, $5,000 to play around with, or you got 10,000, 20,000, or 100,000. You move into the next level of professional trader when you have a trading plan that you stick to. That's your Bible for the next 25 trades. That's the magic number. You don't change any strategy. How you get in, how you get out, how much on each trade, how you diversify your portfolio. Everything is laid out in the trading plan. What your reasons are for trading, how much you take, each week or each month or whatever it is. You lay out your plan and you trade for 25 trades. After you have 25 trades, then you can assess if you did this properly. If you tracked those 25 trades properly, like I showed you in the trade tracker video. And if you haven't seen the trade tracker, download the trade tracker. It's free. Look at the trade tracker video. It'll show you how to track your trades, not just win and losses, but when you entered, what was your target, how you got out and when, how many days you were in the trade. It all calculates this for you. and notes to each trade if it's necessary. If you strayed from your trading plan, you'll make a note here. You know, I went 3 contracts because I really felt strongly about it versus the 2 that I normally do. Then you can look, what did I do differently that's different from my trading plan, and did it work? How did I vary from my trading plan and it didn't work? So you know not to do that again. And then after the 25 trades, after analyzing the results, what worked, what didn't work, how you strayed, you know, where you said you were going to do this but you didn't, where you stretched out a little bit further when you weren't supposed to, and then reform your trading plan for the next 25 trades. And you will do this forever. There's no professional quarterbacks that after, 3 or 4 years in the league, we've made it to the playoffs a couple of times, don't need the playbook anymore, don't need a game plan anymore, don't need to make a halftime adjustment anymore. We know what we're doing now. No, you always have a game plan. You always have a playbook. 25 trades at a time. So let's get into it. Let's take a look at the actual trading plan. See if I can pull this over here. I have this in Word. You'll get it in a PDF. All right, so let's take a look. So here's the trading plan. I'm just going to kind of go through it with you, and then I'll show you an example of my trading plan. So you can make your own and format it any way that you like. I like to do it in Word and then add bullets each time. So when I'm here, I have, why am I trading? So then I'll just bullet it, and then I'll go, maybe I'll put it in red to make it stand out a little bit, because I'm going to print this out. It's going to be part of my trading plan. So, oops, there we go. Put it in red and say, financial independence, stay home with the dog. I don't have a dog. I'm just showing you. So I like to bullet it out, put it in red, get the whole thing done, print it out, and put it up and read it. Memorize it. Incorporate it. And every time you take a trade, reference back to your trading plan. If it doesn't fit your trading plan, don't trade it. That's really hard discipline. I challenge you to make 25 trades according to a trading plan. Any trading plan. I don't care what it says on it. But if you can you take 25 trades in alignment with that plan? Now, if you get a text alert and it says, buy an Amazon call, and it's going to cost $2,500, and that's like 30% of your account, don't take it just because we're recommending it, because it's a trade that we're putting out there for our experienced or advanced members that have $100,000 accounts. You have to pass on the trade. Or once you learn, my hope is that when you get the text alerts, take the trades, track the trades, do whatever you want. It's your choice. My hope is that after a period of time and learning our trading methodology, the market weather report, all the things that we do, that you'll see a trade alert and go, Roku's up for earnings. Let me take a look at Roku. So it'll trigger something for you to go take a look at the chart. And if what we're saying lines up with what your trading plan is, take the trade. If it's not, then alter the trade to fit your trading plan. Maybe you don't buy straight calls. Maybe you do a butterfly. Maybe you do a put credit spread. Bring in some credit, a little bit lower risk than buying a straight up call. Maybe you do both. Depends what your trading plan is, right? So first thing you want to do is, I'll take this out with the dog here. Why am I trading? This is really important. Your goals today might be different than they're going to be, say, 5 years from now. 5 years from now may be conserving capital. Right now it might be as much capital as you can earn. They might be different. So, but your why is the fuel. Why you're trading is the fuel for what it is that you do. If you don't have a strong enough why, then sometimes you'll trade and sometimes you won't. It won't be that passionate for you. You have to have a strong why. My why is to be financially independent. Now, that's a term that's thrown around a whole lot. What does it mean? It means I don't have to worry about anyone or anything else or any other career The money that's coming in from trading makes me independent, and I can do anything that I want with that money for myself, for my family, or whatever I choose to do. So your why is important. You should have at least 2 or 3 bullets, and I'll show you mine when I'm done. Next, what is my approach? What is your trading approach? So I'll just scroll down to mine for a second just so you can see the sample. So, and I'll put it in here so you can understand specifically. My trading approach, number one, is to focus on bullish swing trades in strong sectors. Now, obviously, bullish means we're hoping the trade goes up. Swing trade is any trade that lasts more than a day is technically a swing trade. Day trade is you put the trade on during the day and you take it off. And there are some requirements for you to be able to do that. I believe with many accounts you have to have 25,000 or more in your account to be able to day trade. Swing trade is anything more than one day. Bullish swing trades in strong sectors that have weekly, daily, and intraday consolidation. That compression, that 3-2-1 liftoff that I'm looking for. I'm looking for an upward trend that's making higher highs, higher lows. It's obviously in a trend. It pulls back a little bit to the 21 period moving average, and it pauses. It takes a breath. It coils up. It builds energy. It compresses. It consolidates, and it's ready to fire. And I use my indicators to let me know when it's going to fire and in what direction. That's the 3-2-1 liftoff indicator, and that's available obviously with our course, and we'll talk about that later. But that's my main approach, are bullish swing trades in these strong sectors, the main strong sectors. There's 11 of them, the spiders, and I look for that consolidation or that compression. That's my main approach. Number two is I love reversion to the mean trades on daily charts, like we did on the VIX, like we did on a bunch of them, where the stock pushes up to the upper Bollinger Band, stretches 2 closes above it. Now I'm looking to trade that down to the mean. The mean is like the midpoint between the 2 Bollinger Bands, right? And when it comes down to the mean and it drops a little bit further and hits the lower Bollinger Band, 2 closes below, I'm looking to trade that bullishly up to the mean. So reversion to the mean means it always reverts back to the mean. We've talked about this endlessly. And the last thing is a theta positive portfolio. I don't want to just have calls and puts where I have massive theta decay, where I'll put on a trade, I've got less than 14 days to go, and every single day I'm losing 40 or 50 cents of my premium. The premium and the value of my option is shrinking every single day that gets closer to expiration. That's theta decay. So I want to have, overall, I want my portfolio, at least for me, my approach, is to have a theta positive, meaning I'm doing put credit spreads or have trades on where I want theta decay. You want theta decay when you're selling premium. You sell premium, you want it to hurry up and decay because you took a credit in. Remember, there's always 2 sides to a trade. So if I'm buying a put, someone else sold that put to me and they took in the credit. Well, I want the stock to go down. If the stock doesn't go down, I'm going to lose that money. Let's say I spend $4 on a put, and that's $400. And in 2 weeks, the stock never went down, continued to grind higher. Day after day, I kept losing until at expiration, that put was worthless, right? I lost the 400. Well, guess what? John across the street sold the put to me, right? So John took the $4. $4 I spent on the put when I bought it went to John because he sold it to me. So he's sitting on $400, hoping that the put is worthless at the end of it by expiration. I don't want it to be worthless. I want it to be more. He wants it to be worthless. Now, why does he want it to be worthless? Because if it's worth nothing, he gets to keep the $4 that he sold it to me for. That's called selling premium. That's theta positive. He wants theta decay. He wants that the value of that put to shrink down to nothing so that he can keep the credit. So I want to have, on balance, a theta positive account. I'll have calls, I'll have puts, I'll put credit spreads, I'll have butterflies, but overall I want to try to focus on having more theta positive so that I don't have to worry about my calls expiring worthless. So what are your goals? Next thing up is what are your goals? And I like to put weekly, monthly, annual, which is long term. So if it's good to have a goal as to how much do you want to wire out of your account each week. Like for me, I want to wire out a certain amount statically every single month, every single week. Every week I do a wire out of my account into my checking account. And then for long-term growth, at the end of the year, whatever my long-term profit is, I take 50% of that profit and pull it out. So my account starts here, and I wire out each week, and it continues to grow, and I'm wiring out each week, grow, 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 and then at the end of the year, whatever amount that it grew, I take 50% out of that at the end of the year, and now that account is bigger than it was the year before. Each year, my account is bigger and bigger and bigger, but I do take out chunks of it at the end of the year, and each week I want to wire out X amount. Now, you might not be able to do that in the beginning. You might want to have a goal of $500 a month. Let me pull out $500 a month, and then that forces you to look at your net liquidating value, not how much did I make on this trade, how much did I make on that trade. You know what you're focusing on? You're focusing on the balance. What is the balance of my account right now? All in. If I were to sell everything I've got, or buy back everything, whatever it is, what is the net liquidate? If I liquidated my account, what is the net liquidating value? And you want that net liquidating value to be moving up, up, and up. It doesn't matter if you lose on a trade. It doesn't matter if you make a trade. What matters is that number each day, each week, you just gain a little bit more. I have no problem having 3 losers where I lose $50, 50, 50, 50, and another one trade I made $250. So if I made $250 and lost 50, 50, 50, what's my net liquidating value up? It's up $50. Doesn't matter how many you lost or how many you win. It's making sure that your net liquidating value curve, your equity curve, is moving up. So set some goals. My objectives, again, my objective is to have a strong equity curve, which you'll see here. First and foremost, a relaxed style, of swing trading with zero emotion. That's my objective. I don't always get there. I get emotional too. And the worst part is euphoria. It's the high five syndrome. When you're high-fiving yourself on a trade, look out. Doom and gloom is coming. It just works this way. You cannot get euphoric. The moment you get it euphoric, for some reason, the trading gods start working against you and your account is down 30% the next day. Don't do that. Zero emotion. And like I said right here, to create an upward equity curve. What markets will I trade? Now for me, I'm trading the equity markets. For you, it might be Forex, futures, but for me, I'm trading equity only. What time frames? For me, I'm looking at weekly, daily, and then the intraday charts I'll look at too, the 195-minute, 78, the 39, and the 15-minute charts. That you can set up super easy. What setups? Well, this is pretty important. So my setups for me are the compression consolidation, the 3-2-1 lift-up. That's mine. And I like them nested. What does that mean? Nested means that when you're looking at Apple, for instance, and you look at the weekly chart, and the weekly chart is in a compression. Okay? The Bollinger Bands have squeezed inside the Keltner channels. It's quiet. Volatility is low. And right now, on the weekly chart, it's low and ready to explode. When I look at the daily chart, same thing. There's a compression, a consolidation, low volatility, ready to explode. So that's nested, okay? Weekly and daily. You can have daily and a 30-minute. That's a nested compression too. I love those setups. I also am interested in the high short interest setup. There's at least 15% of the public are short. I love that. Because when the stock starts to move just a little bit up and they start losing money because they're short, they start to panic. When they panic, they start to sell. When they start to sell, buyers come in and buy it up. And they can't sell it fast enough. And we can't buy it fast enough. And when buyers move into a market, it lifts the stock price up. I love short interest runs. And obviously IV runs, that's volatility, and directional earnings. I love directional earnings plays. We talked about that in a later video. How am I going to find new symbols? Now I highlighted here new because I already have a methodology that I use and the symbols that I love. But how am I going to look for new symbols throughout the year? So what I do is I look at the top 10 holdings for me, the top 10 holdings of the spiders. So I'll look at the tech spiders, I'll look at building materials, I'll look at energy, XLE, and see what are the top holdings in that index. Look at the top 10 and take a look at those and see if I see any upward trends that are continuing, some compression I can take advantage of. So I'll be looking at some new symbols inside of those sectors. I also love the IBD 50. That's Investors Business Daily. So you can go to that website and look at the IBD 50. It's free. There's the list. And they do have a subscription that's worth it as well. But I'll look at the IBD 50 like once a month and just see what are their top 50 stocks. If they're not already in my favored stocks, I might add one or two. That's where I'm looking for. What are your entry rules? Okay, be very specific on entry. For me, weekly consolidation near or at the 10 moving day average. This is really important for me when I'm looking at a weekly chart. I like to see the weekly hug the 10 simple moving average. For some reason, if you put the 10 simple moving average on a trending chart, a weekly chart, you're going to be shocked how price just hugs along that moving average. And as long as I have a close above the 10 simple, I'm considering that as, a trend that I want to take a close look at the daily and make a trade. The daily consolidation we talked about, and I talk about how I get in and how I get out. I do not have stops that I use. You might want to make a stop depending at your allocation, how much money you have to spend. Give you an example. If somebody has a $5,000 account, they don't want to lose more than $250, which is 5%. Well, you can still take a trade that's bigger. Just put your stop at $250 loss. So if you buy a $500 call, when it's down 50%, you get out. No matter what's happening, you get out. You only lost the $250. It doesn't mean you have to take a $250 trade because 5% of 5,000 and your allocation is 5%. Know what your risk is. For me, I know what my risk is 100% of the time. And I'm willing to risk all of it. I will never take a trade unless I'm willing to risk everything I'm putting into that trade. That's a mindset that keeps me from having fear. If I'm down 40%, great. I'm 60% ahead of the game because I didn't lose the 100%. I'm willing to go through some heat and not panic when my trade is down 20% or 30%. But you want to put specifically, if you have stops, how are you going to get out of your trade? For me, that's when I know the trade is over. If I get a pullback to the 21 and the trade starts to move but then fall back and it hits the 21 and then I have a close below the 21 or even two closes below the 21, for me, it's broken. And unless the 21 period moving average is right next to the 50, I'm out of that trade. Because whatever I wanted it to do, it didn't do. So why stick around? Again, your exit signals, where do you want to take profits? For me, it's all about Fibonacci, and I love the 1272 extension. Spreads, I have different targets. So for spreads, I look at monetary targets a lot of times. If I put on a put credit spread and I take in $400, I'd love to keep the $400, but I sometimes will place an order to buy it back at 20%. So I am guaranteed 80% profit. If this trade starts to move and it's in good shape and 80% of it's sitting there on the table for me to take, I'm out. So not only will I use targets that are price targets, I will use monetary targets, but then that's up to you. How much capital you're going to allocate, that's also up to you. If you're first starting out, 5% might be a little high. You might want to start with 1 or 2%. And again, that doesn't mean if you have a $2,000 account, 1% of it is, 20, doesn't mean that's all you have to spend. You can spend more as long as you get out of the trade without losing more than that amount. I might even go up to 10% if I have like a 5-star setup. I'll spend more. Then this is like how you manage your risk. my pre-market routine. Like, what is your pre-market routine? Before the market opens, what do you do? Do you have anything to do, or do you just pop on at 1 o'clock and see what everybody else is trading? I look at the NASDAQ 100s super quickly just to see if I see a consolidation, anything that's compressing and ready to go. I'll look at my personal favorite lists, and then I'll run a scan for any stocks that are within 10% of a 52-week high. I love those. Why do I love those? Because if they're close to where their recent 52-week high is, that means there's no baggage above. They made a 52-week high, and there's no resistance up here. It's all blue sky. And if it's trending up, and I get a little bit of a pullback, and it made a recent high, I'm looking for that thing to go higher and break through and continue to make a new high because there's no resistance above it. What's my post-market routine? This is more important than the pre-market routine. You have to look at, what did I do today? Start treating this like a business. What did I do? My entries. I'll make notes about the entries that I took. Did I take it too quick? Did I chase the trade? I make these notes so that after the 25 trades that I take, I can look and see what my behavior is. You can't control your behavior. You can't make a halftime adjustment unless you take a look at the plays you ran. It's like when they go into halftime in football. What do? They talk about what just happened. What plays did we run? How did the defense beat us? How did we beat them? Let's make a little bit of adjustment based on that info. New game plan for halftime. And then finally, a list of trading commandments. So I'll just read off a couple of them. The more you trade, the more commandments you'll have. So here, my first trading commandment is discipline is everything. Stick with the plan for all 25 trades. I have to remind myself of this. The second one, I will not chase any trades that start to move before I get in. If I evaluate a trade, it's pulled back, it's in a perfect compression, and then it gaps up, and now where I wanted to get in, it's about $2 higher, I'm out, unless it pulls back throughout the day. But if it starts to take off, let it go without me. Earnings, I will not hold any earnings trades, and if you've seen some of my posts on Instagram, you'll know what I'm talking about. You can go to tradewithme_now. That's my Instagram. Do not hold earnings trades through earnings in most cases. I realize that I can always cut a trade loose that isn't working and get back in. It's better to close a trade at 40% loss and then re-enter it on a new buy signal than to stay in the trade and see if it comes back. And here's one that's kind of fun. Don't lose your ass on Fridays. Okay? Fridays are known for volatility. If you're up, take some profits for God's sakes, and don't sit over the weekend on a trade, wake up Monday morning and it gaps down. If you're in your profit zone and you're wondering, should I take profits, should I not? That means take profits. Take partial profits if you like. But don't sit there on Fridays and let something just expire out and lose your ass. All right, so that's the whole trading plan. It's super valuable, and like I said, what you want to do is follow the plan for 25 trades. Just 25 trades. And then reevaluate. Go to the trade tracker, that's where you're going to put your trades, and don't be a quarterback without the game plan. You will lose more times than not if you're not following the plan. And then make your adjustments at halftime. All right? I'll see you in the next video.